I hope you enjoyed the encouraging first episode with PCAOB Board Member George Botic. Today on Part 2, George and I discuss PCAOB hot topics, critical audit matters, and the use of specialists in accounting.
There could be cases where there's a CAM year one and then it goes away. There could be other cases where there's a CAM and it stays there. So not to say one's right or one's wrong or good or bad. It's more, what kept the auditor awake at night.
Hello and welcome to the Lease Alert, where we have conversations with the smartest, most interesting people at the intersection of real estate, leasing, and accounting. I'm your host, Matt Waters. Let's learn something together. So George, I want to ask you and I met last summer at the University of Southern California. It was actually an FEI event, and it's called I'll paraphrase, the annual SEC and Financial Reporting Conference. And you gave a presentation there along with your counterparts at the SEC and the FASB and other experts from the industry. And you spoke about critical audit matters, or CAMs. Can you summarize the points that you made there, including what a CAM is and what you view as the value of CAMs?
That's a great question, Matt, and thank you. Before I get into the question, just give our quick disclaimer that the views I expressed this morning during our discussion are in my official capacity as an individual board member of the PCAOB and do not necessarily reflect the views of the full board, the full 5-member board, my fellow board members, or the PCAOB's dedicated, hardworking staff. So with that out of the way, these are just my views. I think it's fair to say I feel very passionate about the profession, as we just talked about. I also equally feel passionate about CAMs. This is CAMs with a C. Critical, as you said. There are international standards that are also CAMs, but they have a K. So it's a little different rules, but focusing on the C CAMs, if you will. Let me start, if I might, just definitionally, and then we'll talk about the value and kind of my thoughts around it. Somewhat simply, a critical audit matter, or a CAM, is any matter arising from the audit of financial statements that was communicated or required to be communicated to the audit committee. So it's something that arguably went to the audit committee. And then it relates to an account or disclosure that is material to the financial statements. So these are arguably significant items. It has to be material. And there's an and this may be the most important phrase of the definition, matters that are not only material, as I just said, but involve especially challenging, subjective, or complex audit or judgment, that involve especially challenging, subjective, or complex audit or judgment, which becomes very judgmental, no pun intended, about what those items are. And one of the reasons I would say, Matt, that I feel so strongly about CAMs is because I also feel strongly about transparency and the need for transparency. Not only transparency for the PCAOB, because I think the PCAOB, speaking very directly to the PCAOB, and what we do here, what I do here, is making sure we're transparent in providing information to investors, audit firms, audit committee members, other stakeholders, the academic community, about what our activities are and what we're doing here, but also from a firm perspective, and making sure that we can, either by rule or by talking about it, that firms are being as transparent through the audit process, because the audit process, to someone not involved with the actual audit, isn't very open. You can't really see what's happening. And not to say everything should be open, I want to suggest that, but having more insight, and I think quite frankly, we need more insight around the audit process for investors or others. And CAMs are, I think, a critical and integral way that an auditor has the opportunity through the audit, using the definition I just mentioned, to include more information in their audit report that I think will benefit, or has the opportunity to benefit, stakeholders, particularly investors, as they're thinking about their decisions. And one of the areas that I've been focused on, even before becoming a board member as a staff, but certainly as a board member, is the number of CAMs, because that number, the frequency of CAMs, is important to that transparency. And I'm concerned there are too few CAMs. And if you think about what a CAM's purpose is, there's information, as some would say, it's asymmetrical. The auditor has a lot of information. The standard traditional audit opinion doesn't really say a whole lot that's unique to that audit, assuming it's an unqualified opinion. And then investors or others are trying to understand, what did the auditor think about? Is it a high quality audit? things like that. And I think CAMS has the potential to bridge that asymmetrical gap between that information that, again, not just conceptually, but I think practically can help investors, because we've heard this from some investors directly in some of our outreach, help them bridge that gap, that information gap, as they're thinking about making investment decisions around a specific company or what the auditor did. And I'll also mention just quickly that there's been a bit of academic research around this topic. Because CAMS came into being now quite a few years ago. CAMS aren't new anymore. They've been around since 2018-19 period as the standard became effective back then. And there's been academic research, both from a CCAM perspective, the US perspective, as well as from the KCAM, the international perspective, and trying to compare them. But one analogy I think is worth just mentioning quickly comes to like the medical profession, not because you said you want to be a doctor, Matt, but thinking about a medical exam or a checkup, so to speak. And it's not a perfect analogy. It's a bit rough, I'll say up front, but I think it does have some salient points that if a doctor's summary says, well, George, I've had your annual physical and you're fairly healthy. Well, what does that mean? Does it mean, do I have high blood pressure, hypertension, or maybe I do, or do I have high blood pressure, but it's under control through medication, so I'm, quote, healthy, or maybe am I diabetic or have pre-diabetes? And what does that mean? If you think about from an insurance provider, if the output is, well, I'm fairly healthy, or does that get information that they need? And you kind of analogize that to the investors. And I think from a doctor perspective, we probably say, well, what do you mean by fairly healthy? Like, why fairly? Am I healthy or not? So why am I fairly? What are you focused on? What are you concerned about maybe? Or what are you thinking about when you look at my readings, so to speak, in blood pressure, diabetes, heart rate, et cetera, pulse rate, things like that. So I think from an investor perspective, we probably wouldn't accept that from a doctor, probably. Well, the analogy is also true from an investor perspective. So that's kind of how I think about CAMS. And the last 2 points I'll mention, Matt, and I'll pause. I think fundamentally, simply, the rule and the standard was trying to get at what keeps the auditor awake at night. What's he or she thinking as that partner or the staff, the engagement team are wrapping that audit up and are thinking about audit committee communications, what's material, going back to the phrase, what areas were especially challenging, subjective, and complex, and what can they say about what they did around that. So I know it's complicated. I know it's complex from an auditor perspective. I don't want to minimize that, but I really encourage auditors to think through as they're wrapping, as they maybe right now as we're talking, wrapping their year-end audits. One other data point I'll mention, having been involved while I was with an advisor, Chairman Doty back then, this was coming through the process with the board and the staff. So we spent a lot of time thinking about it. And I've reflected a lot about that time. I don't think we really thought, well, should there be 2 CAMs per opinion, 1 CAM, 4 CAMs? I don't recall discussions at that level of detail, but I do think we thought that it would be somewhat rare where there would not be a CAM, and it would not be unusual to have maybe 2, 3 CAMs, depending on the nature, complexity of the company. And I say that just as one example. You look at the 5 largest market cap companies in the US, and you think about Microsoft, you think about Apple, NVIDIA, Alphabet, Amazon, companies like that. And you kind of ask yourself, well, gosh, how many CAMs would they have as a group? And it's kind of interesting because you think they're very complex. They've got a lot of activities, US, globally, a lot of acquisitions, things like that. And the total number of CAMs, just factually, for those 5 companies is 7 in total. That does seem a little bit low, I would say, just on the surface. So I think about things like that. Are auditors thinking more broadly about what meets that definition, and are we really kind of challenging ourselves? And I think audit committees have a role to play here. Are audit committees also thinking about CAMs and how, I believe, how important they are to the financial reporting process and ultimately to transparency?
That's enlightening. Thank you for that description of CAMs. I guess I'll just follow up briefly. Is there a right number? And I think as an accountant, I mentioned most of my experience is in corporate accounting or an industry. I might feel a little bit disappointed if my area, the lease accounting area, for example, had a CAM. So should I feel bad about that if I'm in charge of lease accounting at a big company and the audit committee gets a note from the auditor that something in my area has a cam associated with it?
No, absolutely not, in my opinion. And that wasn't the intent of cams. Having more cams or less cams, that wasn't the design. So if a company has fewer cams, does that mean they're less risky if they have more cams? That wasn't how we thought about it back then. So how I thought about it back then. But it is a difficult question because it is very judgmental, and the auditor does have an important role to play. But again, I think the audit committee could be asking questions or should be asking questions around cams. And what's really highlighted this, if you will, is the number on a macro level keeps declining. So back in 2019, roughly at that period, kind of pre-COVID, I think on average, if I recall correctly, it was about 1.69 cams on average for large accelerated filers. And that number has declined from 1.69 to 1.3 in 2023. So a few years later, it seems to be declining. And I think other studies have shown the same thing. It does beg the question, and this comes back to your point maybe about leases to some extent, is over that period from 2019 to 2023, 2024, have things gotten less complex, less subjective, et cetera? I'm not so sure. I mean, you think about what's been happening with technology, with COVID, with just supply chain issues over the last few years. So that's kind of where, at least as I've thought about it. And a couple of quick things, as you and your listeners may be aware, in September of last year, so last fall, the Center for Audit Quality did a survey where they surveyed, I believe it was 100 institutional investors about CAMs specifically, had a number of questions on CAMs. And I wasn't sure what the survey was going to say. I've said this before, and when I saw the email for the survey, I was very interested in it, but wasn't sure what it was going to say about CAMs, because there's been a question, do investors use CAMs, even though we've heard they do in one-on-one meetings, et cetera. But the survey results, I believe, said something like 92%, if I have it right, of those 100 institutional investors responded that they do use CAMs and consider CAMs in making investment decisions. So that, to me, that was a very powerful survey and results that, well, yes, CAMs are being used and are considered in decisions making. Now, let me go back maybe just the point you raised about should you be concerned if there is a CAM. The way I've thought about it, and I think this is consistent with the rule, but doesn't maybe say it quite this way. I think there's kind of two buckets of CAMs, if I think about it. One could be a CAM that could arise from, say, a transaction. A company does a big acquisition, they do a spinoff, maybe they sell something. So in the year that happens, that could very well be a very material item. It could be very complex, judgmental area for the auditor. So makes sense that is a CAM. And maybe for the following year, possibly, it could be some lingering effect, I don't know. But then after that period, that issue's gone away. So that CAM would not necessarily be reoccurring year after year after year, at least for that one transaction that triggered it. But if I think about areas such as it may be at a big bank or a financial institution, allowance for credit losses, or I think about, say, software revenue recognition or something like that, that arguably could be complex, subjective every year because it is just a complex area. So in those cases, it could very well be that a CAM is there kind of every year because that is where the auditor does spend a lot of time, and given the subjective nature, complex nature, it just makes sense that would be a CAM. Not that there's something bad. That's not to say there's something bad necessarily at all. It's just where the auditor has spent a lot of time. So I think there could be cases where there's a CAM year one and then it goes away. There could be other cases where there's a CAM and it stays there. So not to say one's right or one's wrong or good or bad. It's more, what kept the auditor awake at night. I mean, the fact that an auditor may spend time in leases in that area, as you say, that's where they spent their time. Not to say there's a problem or an issue. Wasn't the objective. So I'll pause with that. I am very happy, as you may be aware, that on our research agenda for our chief auditor's office, CAMs, re-looking at CAMs, is there something we need to do or should consider, either through guidance or possibly a change in the rule? I don't know, but I think it does seem very worthwhile for them to be looking at the CAM standard and making sure it's achieving its intended objectives. If I can go back maybe to your point, I know we're a little short of time now, but given your leasing comments, which have been very helpful, are there certain areas when you look at financial statements and opinions that you see CAMs showing up in the lease area?
Oh, yeah, absolutely. Yeah. Thank you for asking that. A lot of times we do have a lot of lease accountants that join our webinar, so this will be useful. I'll tell you the top three lease accounting CAMs. But first, I'll tell you about when I first found out what CAM stands for in this context. Now, I think that was in 2018. And prior to that, I thought CAM always, in the context of leasing, was common area maintenance. But, right, in this context, it's not. CAM is critical audit matters. And in 2018, I served on a panel at the Workiva conference, and it was a session called Lease Accounting and Critical Audit Matters. And it was actually sponsored, that session of the Workiva conference was sponsored by a company that does SEC reporting research called Intelligize. And I was on this panel, and I'll use this just to go back to the profession and get a little encouragement here for a moment. On that panel with me was Mark Butler from Intelligize. And later I was a guest on his podcast. And I used Intelligize, that SEC reporting software, to be able to answer this question about the three biggest lease accounting CAMs. Also on the panel was Dave Christensen from RGP. And he left RGP, but I still am in contact with Dave's boss, a guy named Brian Sinclair, and I count him as a friend. We host webinars together. Last time I was in Texas, I met him for lunch in Galveston and looked at the bay, right? I mean, these relationships have lasted all these years. Tim Colber was on the panel from Deloitte. And by the way, you can see a picture of this on my LinkedIn profile. So connect with me on LinkedIn and you can see a picture of all these guys with me down at the end of the table. But Tim Colber from Deloitte, met him at the conference. We've worked together hundreds of times over the past 7 years since then. And we're actually planning to present live together this year at the NRTA conference in Orlando. And finally, Claudius Modesti, who used to be a staff member at the PCAOB. I think he was director of enforcement, but he's in private law practice now, and we stay in touch. And when his son graduated from college, Claudius even asked me to speak with his son and explain what we do at CoStar, because he was interested in the real estate profession. And it turns out, I know, George, from talking with you, that Claudius is a mutual friend.
Yeah.
And so it's a small world. And all that just to say to the accountants, hey, get out there. I know, we had COVID. It's great that we have webinars now as an option, but get out there, go meet people in person. You never know what's going to come out of those interactions. And so now to answer your question, the top three CAMs in lease accounting relate to impairment, fair market value, and incremental borrowing rate, or IBR. And we have white papers and whole webinars recorded about that. The listeners are interested in those, reach out to me and I'll be happy to share. But those are the three main CAMs in lease accounting. But now, George, I want to shift gears in the few minutes we have left and talk about a different topic. And it's really important to me because I consider myself to be a lease accounting specialist. And I think I've earned the right to say that after 20 years in lease accounting. But I think specialists are vital to the profession. As you mentioned, business is only getting more and more complex. So I feel strongly about the importance of specialists. Matter of fact, I feel so strongly about it that I founded the Lease Accounting Institute, right? And we now, as a profession, as a lease accounting profession, we have a professional designation, the CGLA, Certified Global Lease Accountant. And basically, I worked hard to distill 20 years of lease accounting experience into a 16-hour CPE course that's online and on demand. But, I looked the other day, there's 4,000 open jobs that mention lease accounting. And, frankly, there's not enough. We're in the midst of an accounting talent shortage. There's not enough people to fill those roles. So I think it's important to have specialized training programs like the CGLA program, where we can help with the talent shortage and even bring in people from other fields to shore up the gap. People from real estate and lease administration who have pieces of this puzzle already for lease accounting. They're experts in leases, right? They need a little bit of debit and credit training, which is what we're doing with the Lease Accounting Institute. But I want to hear your take on specialists, because I know the way I define specialist is a little bit different from the PCAOB. So George, what is the PCAOB seeing with respect to the use of specialists in financial reporting?
Great. Thank you, Matt, for the question and the tee up there. Just a couple thoughts. One, before I get into lease, I think this is important. Maybe I'll call it a bit of a plug. we do have a number of spotlight documents where the PCAOB has come out. I was always a big proponent as a staff of spotlight documents. I'm incredibly proud of how many we've had on our website under staff resources. But we had one, to your question, interestingly enough, it's very timely, your question. We issued a spotlight, the staff did a few weeks ago now, on use of specialists. And they're focused on what we're seeing in the inspection side. One of the things of the spotlights that might be of interest to your listeners is we have good practices. So we almost always have a good list of good practice where we see firms, large or small, doing things that we think is actually quite good, to try to highlight those so they can be shared across the broader ecosystem. But on this spotlight, coming back to specialists, simply put, and you kind of answered this part of it, Matt, in a way, that a specialist is a person or a firm, it could be, that possesses a special skill or knowledge in a particular field other than accounting or auditing. So you think of actuaries, comes to mind to me, valuation specialists, where it comes to mind, folks like that. And these are areas where the auditor, in his or her role, has to use the work of that specialist. Now, the specialist could be a company specialist. The company could be an insurance company with actuaries on board, or they could have kind of oil and gas valuation folks on board, or leasing folks on board that the company is used to help prepare the financial statements. Or it could be specialists that the firm may have on staff. The firm could have a leasing specialist or a valuation specialist that are employed by the firm, or the firm, maybe in a smaller firm context, typically go out and could hire a specialist that they would then use to help with the audit. So there's the spotlight goes through the various different scenarios of how specialists are used by their background. And just quickly, on the broader point, the spotlights aren't that long. This is about maybe 10 or 12 pages. It does highlight some common areas of deficiencies that we're seeing, because to your point, Matt, we're seeing more use and greater use of specialists around complex areas, fair value, hard to value investments. If you're a broker dealer, could be using a specialist because there's not a readily determinable or observable market that they're being used. But we've seen instances where firms are using a company specialist. Now, if it's company specialist, it's not part of the audit, where firms have not sufficiently evaluated or tested that specialist's work in, because they're part of the financial preparation process if they're on the company side. We've seen instances where the specialist work may contradict things in the risk assessment process. So did the firm go back and rethink the risk assessment based on information that the specialist identified through their work? And it could be using a specialist, like a hired specialist, where they don't have necessarily the skills, knowledge, or ability, and the firm didn't necessarily think through that, how that could impact their audit. So maybe I'll pause there in the interest of time, but I would encourage folks, if you have an interest, not just a specialist, but other areas where the PCAOB's highlighted things such as independence and related party transactions, et cetera, that we have spotlights on. It's a very useful list. So I'd encourage you to look there. But let me pause as we're approaching top of the hour.
All right. Well, George, thank you so much for joining me today. It has been a pleasure to talk with you. I love it when you guys connect with me on LinkedIn. And so I invite you to do that. You see my link there. And I also say, hey, I encourage you to follow George on LinkedIn, because George is quite active. He goes around the country speaking a lot of times with college students about the accounting profession. And some of the things that he and his team post are actually funny. Like Ellen, a member of George's team, the other day, she posted a picture of a calculator collection at the University of Florida. And so again, I just invite you to connect with me, connect with George, follow George on LinkedIn. It is fascinating to see his trips around the country and talking with students, and encouraging, right? Because there is a new group of professionals that are charged up about the accounting profession, and they're graduating shortly. And that's going to be very exciting. But George, thank you so much for your insights. Thank you for joining me today.
Thank you all very much. Bye-bye.
Thank you for listening to the Lease Alert. I'd be grateful if you would like and subscribe wherever you listen. Until next time, keep learning and leasing.